I have strong opinions, but loosely held. This is venture, and I can't have hard and fast rules because if you want to go out and raise a venture fund nowadays, like you better be very motivated because I think the fundraising environment is really challenging. What's really important for us, high level, is looking for strong GP market fit. And so, what does that like actually mean? And the crucial question we will ask is, tell me about your lived experiences.
At Context Ventures, our podcast, Advancing VC, covers all things startup and venture capital, primarily how startups and venture capital are changing. We chat with venture capitalists, limited partners, and founders who are actively working at the frontiers of our industry and are advancing venture capital. Today, I'm excited to be interviewing Jamie Rhode of Screendoor. Jamie, can you please share your journey into venture capital?
Yes, thank you so much for having me on here. I'd say my journey to VC is maybe somewhat unique. I started my career at Bloomberg, had gotten my CFA there, and it really grounded me in using data to help guide my investment decision-making process. I really wanted to continue on in a pathway in a career where it would tap into my intellectual curiosity, but also candidly, where a computer wasn't going to replace my job. So in 2015, I joined a Generation 7 through 10 single family office in the Philadelphia area. Go Birds, have to get that out there. That opportunity was really unique because it set me on a pathway of understanding multiple asset classes. So had the opportunity to be a core part of revamping the asset allocation, revamp the public markets book, the buyout book, and their venture book in particular, where that VC book was multi-stage in nature at the time of my joining, but going down the pathway of truly understanding venture capital and how the earliest stages or funds that write that first institutional check into a startup can really offer investors very unique compounding returns was eye-opening to me, especially in a situation of to continue to grow family capital, to continue to grow any type of institutional capital. You have to compound it without eating into the returns, especially if you have a payout need. And so when it came to venture, learned about the power law, learned about that opportunity set, how many venture funds were out there, how challenging and how much friction there was to go back managers at those earliest stages, not because venture funds didn't exist. I think we all knew the brand names, but to really go get that capital deployed at the earliest stages was challenging because I think, as we all know, you see funds kind of move up the stack and don't stay grounded in seed stage. But we had the opportunity to really build out a portfolio and see that full cycle that included DPI. I'm not sure how many investors get to see DPI in their more recent lifetime, but part of that journey led me to meeting some of the co-founders of Screendoor, which Screendoor was started by 10 established VCs that also saw a very similar opportunity to me, that there was a lot of return alpha at the earliest stages, but there's a lot of friction complexity for LPs to go back that part of the market. And so could they democratize access for a subset of LPs to gain exposure to the earliest stages while also providing mentorship and helping these fund managers go from investor to fund manager, which I'm sure on your own journey, you realize how hard that really is.
Screendoor is really unique in the sense of it was, I think, as you described, started by 10 GPs or 10 firms, and they know what it's like to start a firm. Can you talk about what does Screendoor do in terms of not just capital, but mentorship?
Yeah, and I think in particular, the earliest stages, especially for emerging managers and for LPs, the venture market is incredibly fragmented. And I think for LPs, capturing the return in that space is really challenging. It's operationally intensive. It requires deep relationship to access the best managers out there. And it's really hard to scale without building an entire venture team. And that's not just on the investment side. The operational complexities of managing capital calls, distributions, tracking down your K1s, especially if you're a taxable LP, that's a big headache. And I think this is really where Screendoor's place in the market starts to exist for the LP side, because it does provide curated exposure to these emerging managers where you can build those direct relationships with the underlying GPs, start to get comfortable. And we recognize that LPs, they have a different flavor, they all have different needs, and they all have different requirements before they can make, an investment into said manager. And you may need to start that relationship years and years in advance before they get to their fund 3 or fund 4 when you're comfortable making that investment. On the flip side, though, what's really unique is our full-time team is allocators that have built venture portfolios themselves, either at family offices or at, one of the largest pensions in the country. And we understand what the LPs need. But I think the challenge is that sometimes you forget what the GPs need because you're so forward on LP needs that you forget that these emerging managers, they might need help, or they might need some patience to understand that maybe they're still in the ideating phase and they're still building out what their thesis is. And this is really where the involvement of those 10 established VCs that started Screendoor, we call them our GP advisors. And then as of today, we actually have 14 of them. And so it's really interesting because they're involved in the DNA of our firm. So they're all seasoned firm builders. They've built venture franchises themselves. They help us source, they help us underwrite. And the key part that is just so cool to me is the mentorship piece. So they help them avoid the pitfalls of scaling, or they help them with the challenges of building a team, or, dealing with, especially in this market environment, how do I decide if it's time to consider a secondary? I think when you look at that ZERP era, you had a lot of LPs that were really pushing for TVPI up and to the right because everything was up and to the right. And now you have a lot of LPs being like, why didn't you take a secondary? Like, that was the top of the market. We could have returned the whole fund and I could have kept investing in venture. So I think there's a lot of friction there. And I think the skill sets required for emerging managers has really increased and is starting to equate to that of the skill sets I would see that were required in, say, an emerging hedge fund manager or an emerging private equity or real estate manager. They needed the skill sets in a variety of areas of running a business that maybe emerging managers in the past didn't need in venture, but are now required to build an enduring firm and make a lot of these decisions. And so Screendoor just offers these emerging managers the opportunity to receive that mentorship to just help them go from investor to fund manager, just because that journey is really, really hard. And for us to help our LPs build that direct portfolio into managers, they need to be of institutional quality. They need to be capable of being around for a significant period of time. And I think that really takes a full-time job, and that's really why Screendoor exists.
You talked about mentorship and you talked about institutional quality. And one of the things I frequently have heard you talk about, whether that's in our first interaction in 2021 or blogs or when I go to events, is around portfolio construction. I feel like you have and your team a strong view on portfolio construction, and that's been a healthy debate the past few weeks. I'm curious what if you could share that.
I'd say it's a healthy debate internally as well. So I have strong opinions, but loosely held. This is venture, and I can't have hard and fast rules. And so I would say that my colleagues have somewhat of a differentiated view than me on portfolio construction. And at Screendoor, we back very diversified managers. We also back concentrated managers. I think that in the mindset of an LP building out a venture portfolio, you have to understand what your end goals are and what your end return metrics are. And so leveraging structured diversification is really important in an asset class where the dispersion of returns is so wide, not just amongst startups or fund managers, but candidly amongst vintage years. You don't know when the biggest winners will be produced. And so the conversation we always have with managers, because at Screendoor, we focus on funds that write the first institutional check into a startup. So pre-seed and seed, sometimes that means Series A, but it's very first check focused. And so when you look at the math of things, where do the bulk of the returns come from? The earliest stages. So it's really important for a GP to take the mindset of their investment strategy to be, one, making sure I do enough deals to feel confident that I'm in a winner. Second, making sure I'm grabbing as much ownership as I can in that first institutional check, because again, that's the cheapest entry point. And then third, then we can have a conversation about reserves. And I think what we're seeing actually of late in this market environment, with certain areas or certain pockets where valuations are starting to tick up a bit, that GPs that have had a reserve bucket are choosing to pull from that reserve bucket to secure their ownership at that first check-in, which I think is a very prudent approach, because if you're going in at the seed and you choose to follow on into the A, that's going to compress your multiple. And candidly, I don't think you have that much more information to know if it's going to be a true venture winner. You may have line of sight to potential pathway of real revenue or sustainable revenue, potentially a pathway to profitability, but to know at that Series A point if they're really going to be a $10 billion exit, that's a hard thing for me to process and understand. And so it's more around stress testing a fund manager's portfolio construction within their strategy, within their focus, and within the sector that they're playing in. And I think it's really helping them understand how market environments can shift so quickly mid-investment period, to ensure that your approach is flexible and adaptable enough to achieve a venture-like return.
You mentioned before that you have a preference, and I don't think it's a strong preference, but for managers who make around 50 investments per fund. I'm curious, is there a number where it's too much? Where like we interviewed Charles at Precursor, and he said he wants to do 80 to 100, and we're on target to probably do around 50 to 60 investments. And I'm starting to feel that my time and energy is being very spread. And so I'm curious if you have a point of view on like, is there too much?
Yeah, I think that's a great question. And the way I would answer that is, when you look at the math, in theory, if I could build an ETF of early stage venture and capture every single solitary startup out there, I would be guaranteed to get the mean return. And the mean return of venture is highly attractive. The challenge is that's not possible. Like, I can't go buy an ETF like I can of the S&P 500. And so if you did everything, your return would actually look very similar to top quartile returns, because the mean and the top quartile of early stage venture are correlated about 90%. So that sounds great, but the reality hits the road, and that's not a viable option. It's also why fund to funds typically end up outperforming direct funds, because of that power law, and they naturally lean into diversification. But I think what's really interesting is that, in particular for venture funds, the amount of deals you do is, I think, a question you have to ask yourself around setting expectations with entrepreneurs. So if you're a venture fund that promises to make a lot of introductions to, say, customers, entrepreneurs will be rightfully mad at you if you don't deliver. But, especially first-time entrepreneurs with limited experience with investors, they're not exactly well calibrated on what VCs can or can't do for themselves, and have unrealistic expectations. So I really think it's on the venture capitalist to set those expectations and say, I'm only going to devote 30 hours a week to my founders, because you could devote 50 hours a week to your founders, and that may not be the best use of your time. But whatever time you choose to devote to your founders, whether you have a 20 portfolio company or a 50 portfolio company fund, it will get filled up. But I think what's challenging is you could fill that time up with founders that at the end of the day are going to fail. And so are you actually using your time appropriately? And so I think that's what's hard, because it takes a discipline to draw a line to focus your time on things that will actually drive the most value. And so for you as a GP, what creates the most values for your LPs? Deeper involvement in a smaller number of companies, or more selective involvement amongst more companies? But ultimately, it's you setting your expectations with your founders and deciding what your true superpower is. And I would say, I've known Charles a very long time, he's one of the founders of Screendoor, is that, companies will die out over time. And so it's whatever your value add is will end up drawing off at a certain period of time. And then you're always able to recycle your time for others. But at some point, you have to feel comfortable saying, no, I'm not going to help you with that. And I think that's really hard, because at the end of the day, we all want to help people. But it's just ensuring that you're finding balance in your own time and your own value add and offering. Because I think at the end of the day, the secret is the best entrepreneurs really don't need that much help from their VCs.
Totally. We see our best companies are the most independent. One of the things I think is awesome about Screendoor is that you all do a fair bit of investing in emerging managers. I'm curious, how do emerging managers stand out in this market?
Yeah, it's a really great question, because at the end of the day, there's there's a lot of them. And I know that the the narrative right now is that there's not a lot of fund one managers, or there's not a lot of emerging managers out there. All the capital is going to the established name firms. And so, people are ignoring this part of the market, which I actually think is a bigger risk to them achieving venture-like returns. But what's really important for us high level is looking for strong GP market fit. And so what does that actually mean? And the crucial question we will ask is, tell me about your lived experiences. So that could be professional or non-professional. That gives you the right to be the best at sourcing, selecting, and winning. And how does that inform your investment strategy and your approach? And so that's understanding the fund size. That's understanding how many deals you're doing. And most GPs know I'm going to come in and encourage or have that discussion around, why are you choosing this number versus why not something that's different. But also understanding, are you a founder magnet? And can you demonstrate the rigor of institutional fund management? I think knowing the difference between being a fund manager and an investor is crucial, and can really help make you stand out outside of the investing muscle. Because you know what, at the end of the day, everyone's ex product manager, everyone has ex network, everyone name drops, everyone has a lot of the very similar features. But I need to understand, one, can you be in a crowded room, essentially the right networks and the right geographies, but have the capabilities of seeing the non-consensus and be right? That's half the job. The other half of the job is running an institutional venture fund, at least to get backing from Screendoor. We're here to help you along that journey, but you need to have that mindset and that framework. Because I ask a lot of emerging managers, and I'd be curious what your answer is like, after they've done their fund one, how much time did you spend investing versus how much time did you spend not investing? And the answer is usually surprising to them. And then I would lastly say that there's a realistic vision for building that enduring firm, not just like hopes and dreams. Like, you have some type of idea of how you're going to do it. Now, 10 years from now, that idea will not actually look like what you ended up doing, but just having that North Star and having that framework in place is really important.
Screendoor is known for being disciplined investors with a rigorous approach to operational due diligence and transparency from GPs. What are non-obvious red flags you all look for in GPs beyond just their track record?
Yeah, and I would love to call out my colleagues on this because I would say that my experiences really focus on a lot more of a quantitative underwriting approach. What are the things that I feel like we can control that impact outcomes? What are the data? Like I said earlier, I use data to guide my investment decision making process. So I would say I spike a lot on the more quantitative aspect of an underwrite. But my colleague Lane, she comes from Texas Teachers and Goldman. She definitely spikes on the qualitative piece of it. So her and I working together is a very collaborative approach. But I definitely want to call out this part of the underwrite to our third colleague, Lisa Colley, where she really focuses on more of the non-investing side. She has a blend of both Lane and I's quantitative and qualitative approach. But what's a part of the underwrite that I think a lot of LPs forget is the operational side of things. And so, what are the terms that a fund manager has set in their LPA? And we make sure that we have a conversation directly with that GP before we get the lawyers involved. Lawyers are very expensive. And so, it's really important not only from a gross to net spread management, but for that GP to truly understand what is in their LPA. Do they have a point of view on how they want to run their operations, their back office, their service providers? Do they have a willingness to learn and contextualize LP asks and preferences based off that? Because LPs are stakeholders. And if the GPs don't have that perspective, they're missing the point of their partnership. And I think that going through that conversation around legal and around operations and service providers and how you're choosing to be a true fiduciary ends up revealing a lot of things about a GP that can indicate red flags, that if they're so wedded on a specific term in an LPA because some brand fund had this term as well, so they must, that gives us information to understand how they will handle long-term partnerships down the road when there could be real challenges in fund management, when there could be real challenges with a founder. So I think what a lot of LPs forget is the non-investing underwrite is just as important as the investing underwrite because it can reveal a lot of information around, a GP's character and how they've been thoughtful or not. But you also need to keep in mind if you're backing emerging managers, this may be their first time doing it. So you need to have a little grace and understand that this is also an educational exercise for them. So seeing how they process that information and how they take it and maybe come back and say, you know what, I've thought about it and this does make sense. And, maybe I was a little uninformed because my only exposure to that part of the job was, via a firm that is not, apples to apples with what I'm doing today.
One of the major changes in venture of late is the rise of solo GPs. And those could be ones that are coming out of established funds or ex-product managers. I'm curious, what's your take outside of your hat of Screendoor, and then maybe what's your take of solo GPs with a Screendoor hat?
I think Charles Hudson could vouch for me saying that I love solo GPs, but I think that at Screendoor we back all profiles. So we back teams, we back solo GPs, we back ex operators, we back ex investors. And I think that as long as that solo GP has the bandwidth and the capability to execute on the fund strategy that they're looking to deploy, we're all for it. I think having checked boxes on a GP's background, profile, whatever it may be, leads you to missing out on the edges or the tails of venture, which is really where the winners come from. And I think some of that is the core reason why Screendoor was started by a lot of those established VCs is because so many LPs have checked box requirements to make investments in venture because they like to have that structure and stability and predictability that I think you often see in other asset classes. And so you're applying that same underwrite or that same lens to venture, but venture is very different than every other asset class out there. So you have to adjust that underwrite, because I did sit in a seat where I underwrote hedge funds, I underwrote long only, I underwrote buyout, and I also underwrote venture. And I was at a culture and a firm that, I was able to understand that each of those underwrites were very different, and having that mind shift to adjust. And not all LPs, I think, have that experience to recognize that a venture underwrite and what has the potential to produce returns sometimes means backing something that's very different and very unique than the typical profile of what you're used to backing in other asset classes.
I believe you have a front row seat on the quality of emerging managers. I met you in 2021, and that was when there was an explosion of emerging managers. I feel in 2023, 2024, and now there's been fewer emerging managers, but as you noted, there's still a lot of emerging managers. I feel some of my peers in 2021, I know some of them are no longer doing venture. And so my question is, do you think the quality of VC emerging managers is increasing, decreasing, or staying the same?
I think the quality is increasing, just because if you want to go out and raise a venture fund nowadays, like, you better be very motivated, because I think the fundraising environment is really challenging, and it takes a lot of time, grit, and endurance to build an enduring venture firm. I mean, DPI is not coming anytime soon when you're starting to invest. And so you have to really love this job, and you have to really want to be whatever your why is. Whatever that why is, you have to really want it and believe it and have it intertwined into your venture fund. I think on average, we've been seeing somewhere around 200 or so plus venture funds per quarter in the market. So we're not really seeing that much of a slowdown, but I think the quality is very much increasing. As I mentioned before, the skill sets that are needed to start and build an enduring firm have been increased. And they remind me of other asset classes where you need to have that knowledge, or at least the resources around the table, to be able to answer and manage a lot more parts of a firm than just being like a really good investor. That's not going to cut it anymore.
What are some of the mentorship lessons that the Screendoor partners who started Screendoor or yourself provide to emerging managers who are going to do a Fund 2 or Fund 3?
Yeah, I think there's a few areas that they really spike on. One of them is team build. I think that is a really challenging area. And I think we've all seen GP breakups. I mean, shout out to the solo GPs out there. They don't really have to worry about that one. Um, but when you're starting off as a smaller team, or you're starting off as a solo GP, and you have goals of expanding the team, I think that is really hard to get right. And so I've talked about this before with Charles Hudson around like his philosophy around hiring. And you can see he's always been a solo GP, but actually his team is very big. And so it's, making sure you're experimenting, making sure you're dating properly, and having those established VCs handy to be like, okay, so how did you ultimately bring on an equal GP? What was that process? Did you make them equal day one, or did you bring them on as a partner and work with us formally in the firm, and then you graduated them to an equal GP? How do you split up the carry? How do you split up management company ownership? How do you do this? That's a really make or break decision, and LPs may choose to pass on you because they're not supportive of team hiring decisions that you've made. Also, around the leap of increasing your fund size, and how to go from, if your goals are to be a lead or co-lead in the future, how do you build that reputation? How do you build that investing muscle to really increase your check size to get to those goals? I'd say also a real life example of one of our fund managers is that they're talking to one of their GP advisors around a portfolio company of theirs that is sitting at a unicorn valuation. And if they take points off the table today, has the potential to return their whole fund. But then you have to do the upside downside case of, do I take the money out today? What am I leaving on the table? How much more compounding will I get if I wait? But at the end of the day, unfortunately, I have to think about fundraising in the future. I know DPI will put me ahead of the curve. And so, how do you make those decisions? You get to talk to someone that's been there, done that, and has probably made the mistake of not selling or made the mistake of selling too early. And so, it's just very helpful, I think, to have a trusted advisor that's been through multiple market cycles and situations of founder breakups or crises that you're just like, I need to call someone quick and get an answer because time is of the essence, and it's just someone in your corner that's here to help you.
I'd love to chat about where you see venture going now, the evolution of it. And you all have very long-term investment horizons, and the Screendoor mission is to accelerate the introduction of new perspectives and talent to venture capital. How do you foresee the broader venture capital ecosystem changing, not just the next year or two, but maybe 10 to 15 years out?
Yeah, I love this question because I'm a long-term focused investor. And so I don't like to think about, necessarily the short term, but in the next decade in venture, I don't think the returns themselves will look that different. I truly believe in innovation. Innovation will keep producing the kind of outlier companies that make venture super unique. And that's candidly been true for decades. What will change is who's capturing those returns and how. The industry is shifting away from a world dominated by few legacy firms. And I think that it's moving much more towards a dynamic set of managers, ones whose lived experiences and perspectives give them a differentiated lens. I always say this: you need to be in a crowded room, so the right networks and the right geographies, but seeing that non consensus and winning opportunities differently than anyone else is crucial to capturing and producing venture like outcomes. So, the ability to spot and support outliers before the rest of the market catches on is where I believe that alpha will truly come from. And so, I think for LPs, the opportunity isn't about chasing the biggest brands anymore. That feels safe. Those bigger brands or the bigger funds tend to produce different returns than the earliest parts of venture. And so to get that alpha, to get that, I should say, unique alpha that early stage venture offers, it's really about finding and backing those managers early before they scale. Because over my career, I've seen a lot of managers raise funds that focus on pre-seed and seed. And then by the time they get to fund 4 or 5, they've moved up and out of that pre-seed and seed space into series A and B. And so you have to reset. And unfortunately, if your goal is to stay focused on seed, you should not re-up. I've also seen a subset of managers that say, no, I love pre-seed and seed. I'm never going to raise more than a $40 million fund. Well, as an LP, to get into that, you either have had to been early or some LP didn't re-up and you got to slide in and take their slot because they become capacity constrained. And so for us at Screendoor, our role is really to bridge that gap, giving LPs a much more scalable, cost-effective approach to gain access to these managers, while then also helping GPs build firms that last beyond Fund 1 and 2 so they can keep compounding their insights over time and really, help the ecosystem expand.
We started the podcast, and you mentioned how you got into venture, and you talked about how AI might be an area that could impact venture, but much later than other industries. I tend to believe that AI will, in the long run, really impact venture, and almost all VCs will leverage AI when making decisions. I'm curious your thoughts on that.
Yeah, I think that I believe in innovation, and having worked for a Gen 10 family office who saw lots of things and lots of market cycles, it's taught me that over the long term, especially in public markets, it's up and to the right. I mean, I can't tell you how steep the slope is though, but it's always up and to the right if you truly believe in innovation and have a very long-term time frame, just looking at historical market data. Now, that is definitely, my compliance officer will make me say that that is, past returns are not a guarantee of future returns, but from my own perspective, that I truly believe in innovation. And so if this wave of innovation is AI, I'm all in, but having the mindset that this wave of innovation will produce another wave of innovation and another wave of innovation. And I think it's really being patient and understandable that how will that impact venture funds? How will that impact companies? Being thoughtful about deploying that capital, and that maybe what's happening is that the early inflection curve is not indicative of a long-term inflection curve. And so don't go into the hype cycle, don't go into the FOMO. Stay grounded that AI is impacting everything, and that you want to be mindful of building a portfolio that makes sure it gives you coverage of all the sectors of today and all the sectors of tomorrow. And so I truly believe that AI is going to allow venture to continue to compound. But I think I've learned my lessons, especially being in public markets before, that trying to make predictions and investments off that, really, really hard.
We've talked a fair bit about Screendoor, mentorship, GPs who have seen it. And as a emerging manager, when I think about mentorship that I can leverage, it's my LPAC. I'm curious, do you all have points of view on what is a ideal LPAC setup? How many people should be on the LPAC? How often should you engage with your LPAC?
Yeah, I'd say a crucial part of the value add that Screendoor offers to GPs is that most of the time we are taking an LPAC seat. And so what we've experienced is that a lot of managers don't know how to use their LPAC, and we're here to be your friend. So there are certain scenarios where let's help walk through how you're going to set up your AGM, or let's help talk about, potentially, if you want to make a certain investment that may be out of scope or maybe later stage or of different size, we can help you with that. Or, if you get to the point of having to have that discussion of taking money off the table, you can leverage your LPAC for many things. And I think that GPs forget that they are in your corner and they're here to be helpful. And I want GPs to know that even though your LPAC members may be very busy and have a lot of other responsibilities, don't be hesitant to reach out. They may not necessarily be able to get on the phone with that in that day, but please use them to be supportive to your end goals, because at the end of the day, this is a marriage. And I think that sometimes GPs forget LP needs. And so you can leverage them to provide you that perspective of, a representation of your LP base. And so I think it's just remembering and reminding GPs out there that, like, we're here to be in your corner and we're here to help and can help guide you down the pathway of how to build an enduring firm, especially before your next fundraise. If you're thinking about fund 2 or fund 3 or fund 4 materials, like what's necessary, what's important, like we're here to help.
This has been awesome and fascinating to learn about Screendoor and your journey. Now I want to go into rapid fire questions and would love to know what are your favorite treats or what is your favorite treat?
This is really funny because we had a team offsite last week and my colleagues were making fun of me because I said no to a lot of desserts, but I will tell you I'm a savory girl at heart. So I love some good French fries, I love good soft pretzels, and good wings.
And what are or what is your favorite movie?
Ooh, favorite movie. I would say Shawshank Redemption.
Excellent film. And how about favorite travel spots?
Ooh. Earlier this summer, I got to go to Mallorca, Spain for the first time. That was beautiful, great food, great weather, great sights, great hiking. I'd also say I haven't been in a while, but I really love Hong Kong. I think there's just so much culture there and really great food as well. And then my honeymoon was in Thailand, and that was just an amazing experience. So I'd love to go back.
Last rapid fire question. Besides the Eagles, any other favorite sports teams?
A shout out to my Phillies. I'm a huge Philly sports fan in general, but my Sixers are a little disappointing and it's a little embarrassing. But Phillies and Eagles, huge fan. You can ask anyone that knows me, and I am the typical obnoxious Philly sports fan.
Jamie, this has been awesome. Really appreciate you taking the time to chat. Really awesome to just see your journey from Vertus when I met you to Screendoor. Screendoor's mission is super impactful, very much an enabler of the venture capital and especially emerging manager ecosystem. So thank you to you and the entire Screendoor team.
Thank you so much for having me. This has been a lot of fun.